Hey everyone, it's Simon here with another market update for you. I was on vacation in Bali last week, so wasn't really watching the markets too closely, but back on deck this week, actually working out of Singapore this week and enjoying a bit of warm weather away from the cold winter of Perth. But there's a couple of things that have happened very recently that I want to point out to you. So here we've got a chart of SPY, the ETF over the S&P 500 index. These are the levels that we've been watching this year, right? So this was the all-time high in January, the February low after that sharp correction we had, and the S&P has really been chopping around these mid-range levels pretty much ever since. Now, last night, S&P 500 closed solidly above this 78.6 level, and this has been a key level that I've been highlighting. If we can get a close above this level, the January all-time high becomes our next target. Okay, so this has happened. We've got a nice solid green candle here and a close above. I would expect the S&P 500 will now consolidate above this level, and that absolutely means the all-time high set in January becomes the next target. So that's a bullish development. The next thing I want to show you is the Nasdaq. Here's the QQQs, the ETF over the Nasdaq, new all-time highs. Okay, so that is bullish. Nasdaq is trading at fresh all-time highs. Something else even more interesting has happened last night, and let's just zoom in on this price action a little bit. What we had here was a gap open of 1%. Okay, that gapped lower from previous close, 1% down, and actually closed up on the day and exceeded the previous day's high. Now, according to Sentiment Trader, this is the first time that this has ever happened. Nasdaq closing down, opening gap down 1% or more, and then closing higher on the day. That is also a bullish development for the Nasdaq. And the third thing I wanted to look at is the advanced decline line for the S&P 500. This is also making new highs. Okay, this is bullish. So what the advanced decline line shows is breadth. Okay, if more stocks are rising than falling, this line will be making new highs. And that's what we want to see in a strong bull market. If this line wasn't making new highs, that would mean that leadership is concentrated in a very small number of stocks. With a rising AD line, in fact an AD line that is making new highs, that shows us that it's not just the generals that are leading the charge, the soldiers are joining. Far more stocks are rising than falling. So that, again, augurs well for the strength of this rally. Let's have a look at some of those so-called generals, the FANG stocks. Netflix got sold down very heavily after earnings, as you can see here. Had a pretty solid close on the day, but that's a pretty solid sell-off. But some of the others are doing really, really well. I mean, have a look at Google. Google is breaking out to new highs. Have a look at Amazon, which, remember folks, is not a tech stock, it's a consumer discretionary stock. That's breaking up to new highs. Jeff Bezos is now worth reportedly $150 billion. He's $55 billion richer than the number 2 wealthiest man in the world now, Bill Gates. So Amazon is certainly performing well for him there. So let's just go back now and have a look at some of the sectors. Oh, incidentally, people often ask me, I often get this question, why do I chart the SPY and the QQQs? Why don't I just chart the S&P 500 or the Nasdaq index? The reason is I like to chart what I can trade. I can't trade the Nasdaq index, right? I can't go out and buy the Nasdaq index. I can buy the QQQs, which is an ETF that replicates that index. So I always chart what I can trade. I do look at the futures as well, but most of my clients prefer to trade stocks and options, so I tend to focus on that. But let's go through and look at some of the sectors. So basic materials still looks, neutral to slightly bearish, still hasn't been able to recapture this 50% retracement level, so not much to see here. Financials look pretty bearish as well. I mean, that's a fairly friendless looking chart. Hasn't even been able to recapture the 38.2% retracement level. And let's face it, when you've got charts like Goldman Sachs in a very nicely well-defined downtrend here, it's going to be tough for the financial sector to rally in that environment. Industrials also, and not a lot to see here. It's not a bullish chart. Still can't recapture this 38.2% retracement level. Tech, on the other hand, looks really bullish. Looks fairly similar to the Nasdaq, not surprisingly. Tech is by far the biggest sector in the Nasdaq. New all-time highs last night, and again we had a gap lower on the open and a higher close. That's bullish price action. I wouldn't be looking to fade tech here. Consumer staples starting to look a little bit more bullish. It's got back to the 38.2% retracement level. It's challenging this 2 standard deviations above the mean from this downtrend since January. I'm not going to give a bullish breakout the lower probability here. I still think it could fail here, but if it manages to clear this 2 standard deviation line and the 200-day moving average and this 50% retracement line, certainly consumer staples will start to look more bullish as well. Real estate continues on in a very nice uptrend, easily clearing the 200-day moving average now. Everything looks pretty good there. Utilities lagging behind somewhat. They're still looking more sideways, but at least they've managed to clear the 50% retracement level from the January high. So that is starting to look a little bit more bullish. Healthcare is looking better. Okay, we've cleared the 61.8% retracement level. It's consolidating above this level. That is a bullish development. Our next target will be the 78.6 level, and much like the S&P 500, if we can clear this level, previous highs become the next target. But healthcare is certainly looking more constructive. Consumer discretionary has also hit new all-time highs. Okay, and obviously stocks like Amazon helping out there. Netflix not helping out so much at the moment, but that's a bullish development for that sector. And the energy sector, look, it still looks more bullish than bearish. It's holding up above the 38.2% retracement level from this run up. Now the oil price has received a fair bit of press lately. It had a couple of very sharp down days, but this is where a little bit of perspective can come in handy. You can see that oil is still right at the top of this recent uptrend channel. So even though it's had a couple of big down days, the trend still is very much up. It still looks pretty much intact. And therefore, I think you really want to give the energy sector, the bull market here, or the upside, the benefit of the doubt. Dow Transport's really not doing very much. This is just a pretty neutral chart, still chopping around these mid-range levels. We really do need to see a rally up to this level and these sorts of levels to be taken out before we get more bullish on the transports. But by the same token, they're not providing a drag on the market either. It really just looks pretty neutral. Bonds, nothing to see here, just tracking sideways. Gold, on the other hand, cannot catch a bid. Gold is looking incredibly friendless. Nothing to see here unless you're short. Oil we've talked about, and TLT is a bond ETF. Again, not much to see there. It's probably looking more bullish than bearish at the moment. Last but not least, let's look at the mid-caps. So the mid-caps made new highs back in June. Failed to take those highs out earlier in the month, but this chart still looks pretty constructive. Okay, no reason to get too bearish here. I would expect mid-caps will continue their way up and continue to make new highs. So there you go, folks. Quick midweek market update. A couple of developments there that I think really do strengthen the bull case for this market. Hope it helps. See you next time. Good trading.